Good morning, everybody, and thank you for joining us today. This is a second webinar in a series where we're looking at different stages of funding through the business life cycle and exploring the funding journey all the way through to exit. Our first one we did a while ago. If you haven't seen it and you're interested, it's centered around angel investing. Please go to our Clarkslegal website where you can watch that at your leisure. Today's webinar is focusing on Series A investment, trends and themes, and we're going to look at how investors are approaching investment in today's economic and socio-climate. We're also going to get guest expert insight from both Zafar Kanani of Forbury Investment Network and Naoki Kamimaeda, partner and head of Europe Global Brain, which specializes in supporting startups with investment all over the world. Naoki and Zafar are also going to be on hand today to answer any questions relating to our topic and funding generally. There is a chat function through this software, so please do feel free to ask all the questions that you'd like to, and at the end of the presentations we will put those questions to our panel and do our very best to answer them. So thank you again for joining us, and let's begin by welcoming Naoki. Naoki, over to you.
Yeah, thank you very much, Stuart. So let me quickly share my screen. Just a moment. It's better to make it bigger. Okay, hopefully everybody can see it. So let me talk about Series A investing. So first of all, so my name is Naoki. I'm partner at Global Brains. So then, so let me introduce my firm first. So Global Brains is one of the largest VCs in Japan. So we invest in almost all sectors. So our fund was established in 1998, and we started investing in startups since 2001. So this gentleman, so Mr. Yurimoto, is the founder of Global Brains and also CEO. So at this moment, our asset under management is about 1.3 billion US dollars, and this is our track record. So I think now we have about 200 portfolio startups, and one-fourth, about 25% of startups already exited. So then we are kind of unique in a way as a VC, because we manage not only our pure VC fund, but also our corporate venture capital funds. So now at this moment, so we manage these funds. So we are actively investing from our pure VC fund, so Global Brains 7th. And alongside with this, we invest from these corporate venture capital funds. So we manage these funds as a GP, and they are the single LP of each fund. So that's how it works. So then, so we are headquartered in Tokyo, but we also have offices in Seoul, Korea, Singapore, Jakarta, Indonesia, San Francisco, and London. And last year in January, we set up our London office, and for that purpose, I moved from Tokyo to London to be more focused on European startups. So then a bit of my background. So as I told you, so my name is Naoki, and I'm partner at Global Brains, and I'm heading our European activities. So my background is I used to be a software engineer, specialized in AI and big data at Sony. So I was a researcher at Sony doing natural language processing recommendation technologies, this type of technologies. And after that, I took my MBA in UK. Then after that, I moved to San Francisco to launch a PlayStation 4 business as an engineering manager. So then I spent 2 years in San Francisco. Then after that, quit Sony and changed my career from engineering to VC, then joined the Global Brains. So that's my background. So because of that, so I'm focused on AI, cyber, cloud, fintech globally. So then as a firm, so we are Series A, Series B focused investors. So then in Europe, we are focused on these 8 sectors. So AI, cyber, cloud, fintech, automotive, robotics, aerospace, and healthcare. So then, so we are quite active in UK. So these ones are our UK portfolio. So now we have 9 portfolio in UK, and actually we have 2 in Germany and 1 in Austria, and also we are quite active in Israel and the US as well. So that's why, of course, we are very active in Asia. So we cover almost everywhere in the world. So then let me start talking about the current environment in the investment. So, so as this graph shows, so actually this graph shows up to 2020 Q1. So Q1 2020 was pre-COVID. That's why we did not see a huge effect on venture financing. So actually, the number of deals a bit dropped, but the amount of raise was almost the same. So now, of course, obviously, I think the number of deals dropped more, and also the amount of startups raised was dropped, I think. So then this is a kind of general average size of each round. So as you can see from this graph, so year on year, every year, so the size of each round is increasing. Now, Series A, so about $6.8 dollars normally startup rates at Series A. So then we are seeing kind of bigger round. Of course, because of COVID, that kind of tendency is kind of stopped. Now, maybe similar size, about 5 to 6 million. That's a Series A. So then let me talk about a little bit of COVID thing. So as we all know, so COVID affected this industry as well. So then especially so during April and May, so that was tough. So because of uncertainty, many VCs stopped investing, or VCs are more focused on their own existing portfolio startups. But as lockdown is eased, so the situation is getting better. So then I just put this article showing how much dry capital UK has. So actually, so as this article says, UK ecosystem still has 8.4 billion pounds of dry powder. So that's why, as long as your startup is good and you can meet with VCs in person, or on Zoom also, definitely you could get funded. So that's our current status. So that's why we don't need to be so worried about this. Still, UK has enough dry power, and also VCs have to invest. So because of our mandate and so on. So then lastly, let me talk about tips to approach these investors. So I put several bullet points here. So these ones are all things I look at normally. So first of all, so your stage should be matched with a Series A stage. So in terms of product, definitely the product is mature enough, should be mature enough, and you should have a sellable product. And also, it's better to have a bit of a market traction. So at least maybe around 500K pounds revenues, that would be preferable. And also, you should be able to kind of show product market fitting as well, certain levels. So then also you should have a team. So normally about 10 to 20 people, mixed skilled. And also Series A investors always look at who are the existing investors. So that's why it's better to get funded by some decent angels or seed investors before approaching to Series A investors. So then when you approach to Series A investors, definitely you should have a right plan. So right plan means this kind of things. So first, round size, maybe 5 to 10 million pounds. And you need to decide whether you are open for syndicate and of VCs, or how many VCs are you planning to bring, and also whether you are allowing strategics to join or not. So it's better to have a brief idea of a round structure. Then given this, so required ticket size, so lead investor should be able to put a 3 to 5 million pounds, and the follower definitely at least 1 million pound or so. Then maybe you can have 3 to 4 investors for Series A. That would be ideal. Of course, some VCs would like to take them all. Maybe only one VC can put everything. That's also possible. So then also you need to have a 5-year financial projection. So normally 5 years. So because we'd like to see how you plan to grow. So 2 years, 3 years, of course, you can create more realistic ones, but so we'd like to know more kind of uncertain things as well. Then we'd like to dig into your brain. So what kind of things you guys are actually thinking. So then also you need to have a data room prepared. So because once you meet with Series A investors, definitely they would ask to open up a data room for them. So then also you need to have a clear growth path towards Series B, and during that time, towards that, so you need to show what kind of validation points you'd have going forward. So then based on that, we will kind of validate our assumptions and so on. So then also you need to have a hiring plan, especially senior hires like CXO levels and also VP level. And also you need to have a solid go-to-market and R&D plan. Then also it's better to have brief ideas of how Series B would look like. So timing, round size, and so on. Of course, you don't need to be kind of concrete, just a brief idea. So then lastly, this is very important. So you need to approach VCs with right domain expertise and so on. That's why you need to do some levels of kind of homework studies about VCs before you approach to VCs. So then also lastly, this is kind of good to have, but it's better to understand VC terminologies like wording in a term sheet and so on. Then you can show how professional you are and how knowledgeable you are in this kind of domains. Then yeah, VCs would talk with you more kind of a professional way. So not trying to kind of rip off. So that's also important thing. So yeah, actually that's it, my presentation. So
thank you very much, Naoki. That was very interesting, very interesting overview of the current landscape and some practical tips there for preparation. And I'll just add really before introducing Zafar that what you talk about there in terms of understanding VC terminology at the very end of your presentation and being clear on investor motivation. Part of that, means that you need to surround yourself with advisors and support of people or businesses that have expertise in that field and a track record to get you there. For those who have heard me talk about investment or governance or startup before, you'll always hear me bang on about the importance of not letting anything go by that you don't understand, always asking questions and being clear on what is involved in the process. You must always understand, and therefore you must be prepared to ask those questions. So thank you very much. So I'm going to hand you over to Zafar Kanani, manager at Forbury Investment Network, who's going to give his presentation. Zafar, thank you.
Thanks, thanks, Stuart. Hi everyone. I'm Zafar Kanani. I'm a manager at the Forbury Investment Network. We're a connected business of Clarkslegal LLP, so I'm very pleased to be co-hosting alongside Stuart today. And my thanks to Naoki for joining us and giving us his time. Thanks also to everyone in the audience for joining us this morning as well. Following the last webinar that we did on angel investing, I've been asked to provide some brief but high-level thoughts around where the venture market is going, given some of the sort of macroeconomic changes that we've experienced over the last few months. I thought perhaps it's worth taking a step back and looking back into 2019, which seems an age ago now. There's lots of things that have happened since, but there's a few sort of interesting bits of information that I think will help us contextualize the conversation today. But there was a recent report published by the British Business Bank that suggested that there was an increase in venture and growth stage deals in 2019, but seed stage deals declined for the first time, and this was an end to year-on-year growth since 2011. We saw in 2019 as well that it was the first year the number of companies that received follow-on rounds exceeded the number of companies that were raising first-time equity finance. And we also saw that average company valuations for growth stage businesses fell by 36%. And this reversed an upward trend since 2011. So it was pretty clear, as we were ending 2019, that there were signs that the market was beginning to soften. And of course, what's transpired in Q1, Q2 of 2020 has, in a way, accelerated some of these trends. In an uncertain sort of global economic outlook, of course, investor behavior is being impacted. We saw in the immediate aftermath of lockdown that investors, as Naoki mentioned, weren't doing any new deals. There was exclusive focus on existing portfolio businesses. And what we've seen as the market has opened up, although investors are starting to look at new deals, it's still a challenging time to be raising capital in some ways. And this is particularly sort of relevant to businesses that are operating in sectors that have been really challenged by the pandemic. Those businesses are having to rely on their existing shareholders and investors to raise cash at the moment. And as a result, down rounds are going to be more likely for these sorts of businesses. We've seen that consumption and customer behavior has changed radically, perhaps in some ways permanently. And this is, of course, being reflected in the sorts of sectors and deals that investors are looking for now. Ultimately, this will sort of come down to for investors who are striking a balance between protecting their existing interests and their portfolio businesses, as well as capitalizing on the opportunities that are arising out of the crisis and the pandemic. I think it's clear that investors are sort of being attracted by the relative safety of later stage businesses, businesses that have established business models that are generating recurring revenues and have shown to be viable in uncertain market conditions. So this really comes down to management teams that have adapted very well in these sorts of conditions. And I think investors also are becoming much more active with their portfolio businesses rather than taking a purely passive approach. So they're getting involved in discussion, internal discussions around fundraising, BD, strategy, etc. In terms of valuations and the exit environment, as Naoki mentioned, there is a huge amount of dry powder out there. I think it's unprecedented in many ways, and this is not only a UK situation, it's a global situation. So I think from that perspective, for high quality assets in the right sectors, there will continue to be support for valuations. But as I mentioned earlier, for those businesses that are operating in those challenged sectors, down rounds, I think, are going to be more and more common. Over the last few years, we've seen the likes of sovereign wealth funds, mutual funds, hedge funds, PE funds, all getting involved in the VC asset class. And as a result, because of the sort of additional competition for deals, there has been upward pressure on valuations. What I would say is that some of these tourist investors, in a way, as they've come to be known, I think will be retreating from the market going forward. And because of the reduced competition for deals, there's less likelihood of upward pressure on valuations going forward. In terms of the M&A market, I mean, clearly it's a buyer's market out there. Buyers are going to be much more selective, and indeed they will be looking for bargains and distressed opportunities where there's a good fit to be making asset purchases on the cheap. What I would say to entrepreneurs and management teams that are looking to line themselves up for an exit, I think deferred considerations and earnouts are going to become much more prevalent, and this is simply a function of valuation risk and future earnings risk being shared more equally between buyers and sellers. So I think broadly in all this there is a bit of a silver lining for both investors and businesses. In recessionary environments, businesses are forced to be much more capitally efficient, and so they've got to be able to do more with either the same amount of capital or less, and this is very much enabled by factors like lower advertising costs, for example, which make cheaper customer acquisition costs. Increasing unemployment provides cheaper and faster access to talent. And the broader shift towards home working, of course, is reducing demand for office space, and of course then has an impact on P&Ls, a positive impact on P&Ls of these businesses. The flip side, of course, is that businesses are having to work much harder to win those new clients in a very challenging trading environment. And again, this sort of comes back to how important the value proposition becomes in these sorts of times. So I think I'll leave it there, Stuart, and maybe we can continue the discussion during the questions.
I think you are on mute.
Thank you very much, Zafar. Again, very interesting, and I'm always fairly positive, really. Been through, as many of us have, a number of recessions, but whatever causes a recession still results in a contraction and a need for business to rethink how they operate and lean down, and we're seeing that through the number of restructurings that are going on through brands and high street as well as small businesses at the moment. And yeah, so keep positive, really. I mean, you must believe in your idea, you must be passionate about what you do, and as Naoki says, one of the things that investors are looking at this stage really is the energy and enthusiasm of the team and what's in the brain of the drivers, really. So therefore that is important. And as Zafar was saying, interesting point there, don't necessarily give the buyer, who's the investor buyer, opportunity to question the investment, and whether that's failing to prepare properly for the pitch, or whether that's not ensuring you've got all your T's crossed and I's dotted in terms of your corporate governance, through your company records, through your IP licenses, through tying in those key people and the key management teams. These are all things that you can do with very little input from professional services firms that will put you in a very, very, very strong position when you are looking to pitch for that funding. So thank you both. We do have a number of questions. Sorry to put you both on the spot. I'll begin with one for Naoki. Do you consider, Naoki, that the UK holds its own in being a successful ecosystem in generating interest from funds such as those offered by Global Brain? What do you see as the sort of strong geographical territories that are either up and coming or established as perhaps more attractive locations than the UK for Series A investment?
Okay, so definitely UK has a very strong ecosystem. Otherwise, I didn't come. So that's why we started looking into UK and they started investing. So then also, of course, the reason why we came here is to be more focused on European continent as well. So then, so not only UK, of course, but also maybe France, Germany, and also some Nordic countries. So these guys have a strong ecosystem as well, and also Israel. So it's easy to approach from UK. Then obviously, of course, US is the number one. So these areas, so we are seriously looking at.
Okay. Thank you very much. Zafar, one for you. How important is the ability for investors and founders to meet face to face? We've all become accustomed to a new style of working, where embracing technology for things such as this. Is face to face still as important, do you think, as it was? And do you think the lack of face to face meeting impedes getting deals done and over the line and investment coming in?
It's an interesting question. I think particularly at the sort of very sort of early stage of the market, i.e. angel and seed, well, and across the board, I would say actually, the relationship is so important and sort of drives almost everything. So I think the fact that it was probably one of the factors that stopped deals getting done, new deals getting done during lockdown. And I think it will continue to be perhaps a challenge. Of course, we can now meet socially distanced, etc. People are starting to have meetings, so that's helping. But I think cross-border transactions, funds like Naoki's, for example, if they don't have a person on the ground, then I think those sorts of transactions are going to be much more difficult to get done. So that's my view.
Okay, thank you very much. Another one, how has criteria for investment changed as a result of COVID? And what are the most important criteria for founders to address in the post-COVID economic environment? Naoki, do you want to kick off with that?
Okay, actually, pre-COVID and post-COVID, of course, how VC startups were kind of a bit different. So we are more focused about valuation and those kind of revenue valuation match things, and also runway. So then definitely, so previously, of course, you could burn more money to grow, but at the post-COVID, definitely we'd like to see more tangible stuff in the short term. So that's not so good for deep tech startups, but so that's the environment now. And also definitely you should be prepared to answer kind of how you are going to secure enough runway, at least for maybe 24 months or so, to be prepared for this uncertainty. Definitely we are expecting to see a second wave. So that's why, so definitely you guys should be able to answer this kind of things.
Thank you. Yeah. Did you want to add anything to that question?
I'm done.
Thank you, Zafar.
Nothing for me on that point.
Okay. We do have another one. Again for Naoki, this one. When Global Brain arranges investment, typically what kind of percentage of stakes do you look for during Series A?
So actually it depends on geolocation. So in Asia, we always seek to take the leader position. That's why we are aiming to get more than 10%. So then always we need to get the board seat as well, board of director seat. So then in Europe or in US outside of Japan, normally we don't take the leader position. We are follow investor here. So then, still we would like to be kind of involved in board discussion and so on. That's why we would like to get a board observer seat at least. So then we are aiming to get more than 5%. That's our thesis.
Thank you. Thank you very much. Well, we've got no further questions. So that just leads me to thank you all. Thank Naoki and Zafar for their time and the presentations that they gave in the questions. Of course, if you do think when this webinar's over that you wish you'd asked something, by all means, don't hesitate to get in touch with us, and we'll pass your question over to our two specialists. And as I say, thank you to all of our audience for joining us. We hope you found it worthwhile. As I say, this is the second in a series. The first one was on angel funding. If you would like to watch that or you missed it, by all means go to the Clarkslegal website where you'll find a link to that recorded webinar, and do watch this space for the next in the series. So thank you very much. Keep safe and keep working hard. Bye for now.
Thank you.
Thank
Bye.
you.